Hello viewers, welcome to our channel. This video is the first one in a series of videos relating to cost and management accounting. For better understanding, please watch them in its chronological order. For easy reference, all the videos in this playlist are numbered chronologically. Let us go ahead and discuss the basics of accounting. Accounting is the language of business. As such, all the transactions that are undertaken by a business needs to be recorded, and this recording process is termed as bookkeeping. Recording cannot be done haphazardly. Definitely, there is a set procedure that has to be followed. It has to be done systematically and in an orderly manner. As such, bookkeeping definitely is a part of accounting. It is the record making phase of the accounting process. The terms accounting and bookkeeping more oftenly is used synonymously, but in fact, bookkeeping is actually complementary to the accounting process. On the one hand, bookkeeping is systematic recording of financial and economic transactions, whereas on the other hand, accounting is analysis and interpretation of this bookkeeping records. So, accounting is a broader concept which includes big bookkeeping process as well. Let us go ahead and look into two definitions of accounting. One is given by the American Accounting Association, which defines accounting as the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of the information. We'll go word by word. Uh, Accounting is a process, so it is not a one stage work. Definitely it is a continuous process. It has to be done on rigorously and on a continuous basis by the business organization. Why is it so? Because business as such has will be getting into transactions on a day-to-day basis, and every day there will be numerous transactions undertaken by the business. As such, whenever the business transaction happens, it has to be recorded. Now, why am I stressing not just transaction but business transaction? Is because one of the main objective of accounting is to identify those transactions that are relating to business. By the end of the day, we need to know how much profit or what is the loss that has been incurred by the business. As such, only business transactions will have to be entered in the books of accounts of the business. Once you identify the business transactions, these have to be measured. Okay, these transactions have to be measured. So measuring means quantifying, and as such, all these identified business transactions should be valued in terms of a common currency. In India, definitely it is in rupee terms. So once identified and measured, these transactions needs to be communicated. Now, communicated to whom? Communicated to the stakeholders. Who are the stakeholders? The ones who use the information. They can be the creditors of the company, they can be the shareholders of the company, they can be the general public, they can be the customers of the business, it can be government officers who are interested in the working of the business, right? So, all these people are called as the stakeholders of the business. So, whoever wants to use this information, the information has to be communicated to them. Okay, so the process of accounting involves identifying, measuring, and communicating to the end users of the information. But what has to be identified, measured, and communicated? It has to be economic information. So all business transactions undertaken by the business which are financial in nature, which can be quantified, has to make its way into the books of accounts. Communication is not narrating all the transactions. Okay? It's impossible for the business to read thousands and thousands of transactions that happens in the business on a day-to-day basis. Okay, as such, analyzing it also turns out to be difficult. That's the reason why it has to be these transactions that are entered into by the business should be communicated in a concise manner. It has to be concise and accurate. For this reason, the business prepares the final accounts. So what are final accounts? Final accounts are the financial statements of the business, comprises of trading and profit and loss account, balance sheet, and cash flow statement. Okay, so this is prepared so that at the end of the accounting period, gives the concise picture of what the business was doing in that particular accounting year. To reiterate, the financial statements provides the necessary information in a consolidated manner so that the users can make informed decisions or take judgment call as to how the business has to proceed further. Okay, so definitely this particular definition comprises of all the main activities of accounting. In similar lines, we will look into the second definition given by American Institute of Certified Public Accountants, which defines accounting as an art of recording, classifying and summarizing in a significant manner and in terms of money transactions and events which are in part at least of a financial character and interpreting the result thereof. So this definition is also at par with the previous definition, which mentions that accounting is an art of recording the transactions, classifying the transactions, and summarizing these transactions in a orderly manner, significant manner. And all these transactions necessarily has to be quantified. It has to be measurable in terms of money, or these transactions either wholly or in part it has to be in financial nature. It has to be of financial nature, thereby allowing the users of this information to interpret the result. So at the end of the year, try and find out how exactly the business is placed in terms of its financial standing, or looking at what is the in the short run perspective, definitely looking into the profits that are earned in the given financial year, or what is the loss that the business has incurred. In common parlance, accounting is also known as financial accounting. So, synonymously, accounting and financial accounting terms are used. All the major steps of the accounting process is already discussed in the definition itself, but let us just have a run through of it. So, the process of accounting starts when the business transactions are recorded in the subsidiary books. This is followed by the second step, which is classifying. Now, all the transactions that are recorded in the subsidiary books are classified and then posted into the main books of accounts. Now, these main books of accounts are called as the ledger. So, all these transactions that are recorded and classified will be later summarized, and it will be summarized and presented in a concise form, in the form of trial balance, profit and loss account, and the balance sheet. The summarized data needs to be interpreted so that the interested parties, that is the stakeholders, can make informed decisions. Now, this can take the form of determining either the future earnings of the business house, or trying to understand the liquidity position of the firm, or how profitable the business is in a given period of time. Now, this leads us to the main functions of accounting. Now, which are the main functions of accounting? Systematic recording. So, systematic recording of what? Systematic recording of the transactions. Okay. Measuring the resources, ascertaining the claims and interests, communicating the information, and meeting the statutory requirements. All these are the functions of accounting. So, systematic recording of all the transactions related to the business. Okay, and then measuring the resources. The business has got a lot of resources. These resources are typically being projected in the balance sheet of the company. Let us assume that the business has purchased a machinery worth rupees 10 lakh. Now, this machinery is purchased in 2020, but when the books of accounts is prepared for, let us say, 2021 or for later years, you cannot show the value of the machinery at 10 lakh rupees only. Definitely, the business has used these assets, and as such, the value of the asset comes down when it is being used. Okay, so these assets like machinery, or assets like furniture and fixtures definitely fall under the category of depreciable assets. So as you use the asset, the value of the asset comes down, and in the books of accounts, you need to measure these resources on a yearly basis and project the final value in the balance sheet. Maybe, like for example, machinery 10 lakh less depreciation, charge the depreciation that is allowed for the year, and the remaining figure will be the actual value of that particular asset. Okay, so measuring the resources is also one of the function of accounting. Ascertaining the claims and interest is another function of accounting. So, so the system of accounting actually helps in determining how much money is due by the business to the outsiders. So ascertaining the claims in the sense how much money the business owes to outsiders. Like for example, how much debt it has, outstanding. How much is the long-term loans, how much is the short-term loans, how much would be the medium-term loans which the business owes to outsiders. Remember, there's one concept called as separate entity concept, which distinguishes business from its owners. Whenever we are looking into the business entity concept and we separate the ownership and the business, as such, whatever money that is owed to the shareholders are also treated as claims, and that's the reason why we see shareholders' capital on the liability side of the balance sheet. Business owes capital uh, to the owners of the business. So ascertaining the claims and how much interest these stakeholders have in the business is also one of the functions of accounting. Moving to meeting statutory requirements. Accounting involves recording, classifying, and summarizing the data in a significant manner. Now, this does not mean that these records have to be maintained haphazardly, or it cannot be done as per the will and wish of the business. It has to be done as per the statutory requirements. You need to maintain the books of accounts. The books of accounts has to be prepared keeping in mind the statutory requirements, keeping in mind the principles and the principles in terms of concepts and conventions that has to be maintained by the business. Now, these mandatory requirements can be either from the perspective of the company law, or it can be Income Tax Act, or it can be the GST, the Goods and Services Act, etc. So definitely one of the function of accounting is to maintain the records of the business as per the statutory requirements. And another function of accounting is communicating information. We have already looked into the communication part of it while discussing the definition. So, communicating information about the organization to its stakeholders is one of the main functions of accounting. To sum up, it's clear that the accounting actually accumulates all the data and presents it in a concise manner so that the users of these financial statements can take timely and accurate decisions. This leads us to the conclusion that maintaining the accounts is not only the primary objective. The primary objective is to take decisions on the basis of these financial facts provided by the accounting statements. As such, it is not the final destination of the business. It is actually a means to realize the end goals of the organization and help in taking decisions so as to enhance the profitability position of the business. Moving on to the objectives of accounting. One of the main objectives of accounting is to maintain a permanent record. Okay, so the focus of accounting has to be to maintain permanent record of each and every transaction that happens in the business and to show its financial effects on the business. The second objective is to ascertain the combined effects of the transaction. The business will have to look into the transactions, all the transactions, whether related or unrelated, and then find out its combined effect on the financial position. So ultimately, when you're trying to find out the profit or loss of the business, you don't take related transactions separately and unrelated transactions separately. Definitely not. You look into all the transactions of the business and then try and find out what are its combined effects and find out or gauge the financial position of the business. The third objective is to evaluate the earning capacity. The earning capacity of the business is actually found out through the final statements, financial statements, so the final accounts that are prepared by the business at the end of the year. It need not always be at the end of the year. Periodically, definitely, accounting will help in trying to find out the earning capacity. Maybe once in 3 months, quarterly, or maybe half yearly, records can be looked into, and you can try and bring out the information relating to the financial standing of the business. The next objective of accounting is to ascertain the financial position. So, financial position can be ascertained after looking into the combined effects of the transaction. So, this is more important. When we are looking into the combined effects of the transaction, of all the transactions that has happened in a particular period of time, it will help the business to understand where it's standing financially, whether the position of the company is good, or whether it is average, below average, poor, or whether it is extreme, or whether it is doing extremely well. One more objective of accounting is information. It provides information about the management's efficiency. As I told you, the management and the owners of the business are two sets of people. Okay, so owners need not always be present. I'm talking especially in terms of joint stock companies. Owners will not be present to run the show on a day-to-day basis. They entrust this work to a group of people called as the management. As such, if the business is earning good profits year on year, it indicates that the management, the people who are in the helm of the affairs, are actually efficient. So whenever the owners detect that the profits are decreasing over the years, definitely it's an indication that there is some inefficiency that has crept in, and it has to be set right. Moving on to the next objective, accounting provides information for financial forecasting, formulating policies, and devising remedial measures. Now, accounting data actually helps in forecasting. For example, preparation of budgets by the business. Okay, maybe it might be cash budget, it can be sales budget, it can be production budget. Okay, it can be any type of budget, which is actually a forecasting tool. And where does this budgeting gets its information from? You have to derive it from the books of accounts itself. Okay, from accounting information. As such, one of the objectives of accounting is to provide information for financial forecasting. It also helps in formulating policies. The policy decisions that the business takes ultimately has got an bearing on its financial position. Okay, so whatever decisions the business take, the impact of it is found financially. The impact of it is felt financially, not found. It is felt financially. As such, whenever the management takes up policy decisions, it will formulate its policies based on the financial data that is provided by the accounting process. Not only that, it also helps in devising remedial measures. Now, say suppose if there is a lot of deviations from what is being planned by the business, in such cases, accounting definitely will give a tool for the management to take up remedial measures. So, on a quarterly basis or once in 6 months, when the business looks into how much profits or losses the business has made for that quarter or for that half year, definitely it will provide ample opportunities for the management to set right the next 9 months or next 6 months, as the case may be. Okay, so the future period, the business can actually take up remedial steps to see to it that the business will be put up in the right track so that it can go ahead and perform better as per its goals. The next objective of accounting is that it should ensure preparation of accounts as per some accepted accounting concepts and conventions. If you want to compare the way in which one business is performing with that of some other business in the industry, definitely there should be a common ground for comparison. If the books of accounts are maintained as per the will and wish of the business houses, definitely there is no common ground to evaluate and compare. For this reason, there are set accounting principles that has to be followed by every organization when they prepare their books of accounts. Okay, so accounting process or accounting system that is in place in the business has to ensure preparation of all the required books of accounts as per the accepted accounting concepts and conventions. Moving on to the next objective of accounting is to provide data to the government for taking proper decisions, maybe related to the duties or taxes or price control, etc. Just as an example, whenever a tax has to be paid by the business, the data for calculating the tax obviously comes from the books of accounts. So one of the main objective of accounting is to see to it that it provides accurate data so that the requirements of the government are met. So these are some of the objectives of accounting. The main branches of accounting are financial accounting, cost accounting, and management accounting. We have discussed financial accounting in detail in this video. Cost accounting and management accounting we will be discussing in depth in the coming videos. Hope you all had a pleasant learning experience. Thank you.